In this short video, we will discuss gamma. We will first define gamma and then discuss how this Greek calculation affects the way traders view risk. We will follow through with how gamma affects delta hedging and the way a trader can manage gamma risk. Gamma is defined as the rate of change of the delta with respect to the underlying asset's price. Mathematically, gamma is the first derivative of the delta and is used when trying to gauge the price movement of an option relative to the amount it is in or out of the money. When an option is measured as deep in the money and very far out of the money, gamma is relatively small. When the option is near or at the money, gamma is usually at its largest. An individual option trade has inherent gamma risk associated with the position. The closer the strike of the option to the current underlying market, the higher the gamma. The closer an option is to expiration and an at-the-money strike, the higher the theoretical gamma. Gamma is dynamic risk, meaning that the risk changes as the other option inputs change. Gamma is a function of the underlying price of the asset, along with the time to maturity, the interest rates, and the implied volatility, which are most of the inputs to the Black-Scholes model. The underlying price plays the largest role toward determining the gamma associated with an individual option. Gamma is generally reflected as a percent or decimal, which then can be used to determine the change in your theoretical delta based on a specific market movement. The process will allow a trader to simulate different types of movements, either up or down in a market, and the delta hedge their position will have based on the gamma of the option. Let's take an example. Let's assume a trader owns one contract of Apple option that expires in 30 days. The strike of the option is at the money. We'll say 600 when the underlying price is also 600. The gamma on the stock is 0.5% for a 30-day expiration. This means that for every increase in $2 of Apple stock, 600 to say 602, the delta will increase the theoretical position by one contract or one share. So if a trader has a delta of 0.5 or 50 shares, one contract equaling 100 shares, a $2 increase in the price would generate a delta of 51 shares. The way delta works is as the market rises on either a call or put, which is treated the same at an at-the-money strike, that is delta hedged, as the price increases, the delta will increase, and as the price decreases, the delta will decrease. Positive gamma is associated with long positions in options. When an investor purchases an option, they pay a premium to the seller, and the inherent risk is the time decay, the gamma, the vega, and the delta. The seller of the option has a negative gamma position and receives premium to compensate for this type of risk. When an investor owns a portfolio of options, they can in fact have negative time decay and negative gamma. This can occur because the strikes of the options are spread across a broad range. When an investor purchases an option with the inherent of benefiting from increases in implied volatility and the benefits of gamma, they will generally hedge the delta of the option. That would be the strategy. The delta of the option is the theoretical risk associated with the directional underlying movement of the market. When the delta is hedged, on a long position, an investor can short the underlying market. The gamma will change and the delta of the position will change as historical volatility will drive the probability of the option. For example, if an investor buys one contract of Apple, again, at 600, when the market is 600 and shorts 50 shares, the delta of the option will be close to zero. If the market moves to 660, the delta will increase and the trader will make more on the option than they will lose on the underlying stock. The investor can short another 10 shares of the market to become delta neutral, in this case Apple stock. If the market then drops, the investor can repurchase the shorts. When an investor is short an option, they are short gamma. As the market rises, they become shorter with the underlying stock. And as the market goes down, they become longer and longer. This is an unenvious position, which is compensated by a premium. To hedge negative gamma, an investor can purchase an option at the same strike or offset the gamma risk. If an investor repurchases an option with a significantly different strike or different maturity date, then the majority of the gamma risk will be mitigated, but there will also be some risk associated with position. Gamma risk is an important part of options trading and should be understood by portfolio managers prior to taking options risk within a portfolio.